Hello, everyone. Uh, Good morning, good afternoon, good night. Troy and I will be presenting our analysis on public storage. We chose to venture into the real estate sector because, as we all know, our portfolio currently has no exposure to it, and we wanted to explore if we could add some defense in our portfolio to help balance the volatility. So as we go through, you'll see that I'm gonna be walking close to the camera every now and then to click. Oop, this is awkward.
Yeah, we might just.
All right. So here's a quick overview. I want to first highlight the price to funds from operations ratio, the P/FFO, which is the REIT equivalent of a PE. Unlike earnings, funds from operations adds back depreciation, which is a major non-cash expense for real estate companies. Price to earnings significantly understates profitability. So price to funds for operations gives us a cleaner valuation signal. And as we can see, PSA is trading around 16 times funds from operations, which is a reasonable compared to peers, as you'll see. And next, PSA carries an A credit rating while offering a 4.4 dividend yield and follows the market with a beta of 0.99, and which is a key to lowering the portfolio beta, as you'll see.
So next, just a little bit of the company background. Public Storage is a company that operates mainly in the U.S. and parts of Europe. I'll talk about locations and stuff later, but they provide self-storage solutions through their rental real estate. They market to the customer as an extension of the home, and they also market themselves to businesses as a place to store their extra materials and even serve as office and studio spaces. The industry PSA operates in is mainly in real estate due to the nature of the business, focusing on owning their properties and facilities. And then the company was founded in 1972. So it's been around for about 50 plus years, headquartered in Glendale, California. Next, some of their business model overview. Their mission statement is to work together and be the business choice for our customers, employees, and shareholders. And this is through building a meaningful and long-term relationship with every customer. So more specifically, their core strategy is to own a large portfolio of storage facilities and expand, especially in areas that are highly populated, to tap into that greater demand for their services. The company's revenue is generated through rental fees for their storage units, typically paid on a month-to-month basis, focused on maximizing the occupancy at each location to both maximize revenue generated per facility and then spread out those fixed costs across more of their rentals. And next, business segments. So their product line can be split into two major categories: their storage solutions and services. Their storage solutions consist of self-storage, business storage, transport storage, and then their specialty climate-controlled units. Self-storage is for the general customer for typical storing needs such as decluttering or rehoming items during vacations, remodeling. Business storage is similar but geared more toward businesses to store those extra equipment and furnishings. Transport storage is meant for storing vehicles, both cars and boats, depending on your needs. And they offer parking spots, covered spots, and even enclosed units for these vehicles. Lastly, is their climate controlled storage units, which are specialty units to store like temperature sensitive items, like they use photography equipment, records, and then even wine as examples for these things. And then for their services, the company offers packing supplies to customers to help organize and store their goods, such as boxes, tape, bubble wrap, packing peanuts, etc. And then they also offer insurance on their storage under their subsidiary Orange Door Storage Insurance for customers to add coverage to their stored property.
Awesome. Here's a little bit about the revenue breakdown. As you can see, it's extremely concentrated and predictable. About 94% of the revenue comes directly from the self-storage rental income, which is their biggest driver of cash flow, as we'll see. And about 3 to 4% comes from tenant insurance programs, as Troy just mentioned, which carry very high margins. And it's essentially add-on recurring services. And the rest comes from fees. The biggest takeaway here is the revenue is simple, stable, and recurring. And this company is built around scale, consistency, and highly automated operating model with more than 3,400 properties, 250 million square feet across 40 states, which is roughly the size of 4,300 NFL football fields, if that says anything. One of the biggest strengths is the digital first customer acquisition. Over 85% of the rentals now happen through online channels. But operationally, smart access tech, centralized security, predictive maintenance for fewer on-site labor hours, which as you'll see, compared to competitors, they are do really well in that segment. And from a revenue standpoint, the model is almost entirely recurring. Rents drive the business with supplemental in-place rent increases, tenant protection plans, retail sales, and fees, all being driven by more technology and AI that they're using. Public Storage's footprint is one of the largest in the REIT industry, serving about 2 million customers, and a big portion of their portfolio is still in growth mode. About 22% of properties sit in the high growth lease pool, with roughly 110 million in net operating income upside expected beyond 2025 as these assets mature. A bit exposure through its 35% ownership stake in Europe, which operates more than 275 facility. But this honestly just gives them equity interest and adds some diversification in their portfolio and a presence in markets where self-storage is still developing. And Troy touched on this, so I'm just going to pass this a little bit over real quick. So the broad customer mix, it keeps the demand stable through all cycles. Largest segment is the residential customers. And then it goes down to the serve small businesses, including contractors, e-commerce, and more. One thing about the residential customers is that it's storing due to their life events. And I'll touch on this in the thesis of it's recession proof. I mean, everyone's divorced, you name it. Any big life event, they're going to need storage somewhere. And then another interesting group is the vehicles, RV and boat storage. These typically are high margin and very sticky. And finally, students and military renters that move across the country a lot.
So I kind of touched on the company's strategy earlier, but diving deeper into the core strategy of the company, PSA aims to lead the industry by adding value to their customers through expanding properties to match demand and then operating in locations that are convenient for their customer base. Being that is, the company has over 3,700 locations across the U.S. and Europe, dominating the U.S. with, like Kevin mentioned, over 3,400 locations and about over 300 locations in Europe. PSA is also adapted environmentally, adding some sustainable additions to their locations, such as solar panel energy, and then they're also constantly working to limit their emissions through new productions. And then just a little background on the people of the company. So Joseph Russell, he's the current CEO and president of PSA. He's been with the company since 2002, and he's held the president title since 2016. The company was founded by Wayne Hughes in 1972, and the current chairman of the board, Ronald Havner, was previously CEO of the company before Russell stepped in 2016. The rest of the board is largely independent and also has connections outside of the company and in other industries. So some patents and proprietary information. Given the nature of the business, public storage does not require a lot of patents to protect the integrity of their business. Of the few patents the company holds, they surround the use of their storage solutions like electronic locking devices and automated self-storage on the outside of larger multi-storage facilities, allowing customers to access their units from the outside rather than internally. In regards to their brand image, there was a little bit of a legal debate this year. It's still ongoing, but U-Haul got into a dispute with a company over Public Storage's attempt to monopolize, according to them, the word and the color orange, which Public Storage has denied. But like I said, still ongoing. And then other proprietary information Public Storage holds relates to the customer data, business strategies, pricing models, and then other various company trade secrets.
That's pretty much if you wear the color orange, U-Haul might sue you. So going into the Q3, what recently happened, they delivered a pretty solid quarter with both revenue and EPS beating expectations. In-place rents were up 6% year over year. Same store revenue came in ahead guidance, so all good things. But strength was concentrated in several markets, including Chicago, Minneapolis, Tampa, Honolulu. So those big cities where there's just a lot of demand for public storage in general. This company continues to generate strong internal liquidity, projecting roughly $650 million in retained cash flow for fiscal year 2025. Leverage remains strong and conservative at 4.2 times, reinforcing their ability to invest through cycles without stressing the balance sheet, which I think is a huge pro of this company, which you'll see in the leverage ratios later. Headwinds include LA rent restrictions, dragging their same store results in that city. occupancy down year over year, and competitive supply is pressuring as movement rents. And this is some things management noted. I won't spend too long on this slide. They noted improving industry conditions, their demand is stabilizing, and new supply is slowing. This allows them to raise their 2025 guidance. And growth remains balanced between internal efficiency and external expansion, which you'll see in the acquisition slide. They've had a huge year in that spot in general. PSA continues to operate from a position of financial strength. Go to driver factors of growth.
Yeah, so a couple things that is really propelling growth for the company is their acquisitions and expansion pipeline. So year to date, by the end of Q3, Public Storage has acquired over 135 self-storage facilities. Kevin will kind of touch on that later with their mergers and acquisitions. But they've also initiated many other expansion projects to pre-existing facilities, which has added over 10 million in rentable square feet for the company. Next is market fragmentation. So due to the consistent demand for self-storage, as we've kind of mentioned, there's a lot of private companies and local areas that own a large number of facilities, but they have a lot smaller rental space in comparison to these big public major companies. This allows Public Storage to basically expand through this fragmented market by acquiring these local companies and basically tapping into those areas of high demand without starting entirely new developments. Next is the same store optimization. So the company is constantly running promotions to maximize occupancy and revenue through facilities and adjusting rates for long-term leasers to boost that customer retention, and then adjusting rates to match demand patterns, which improves overall sales for each facility. And then lastly, the company is constantly following demand trends. So outside of acquiring, PSA is constantly focusing on growing and moving into densely populated areas, especially those with smaller living areas, to tap in that need for that extra storage and meeting customer demands, and then just capitalizing on the overall need for these rentals. And then next is just some more competitive advantages tying into those driving factors of growth. The biggest thing for this company, without a doubt, is their scale. In addition to brand recognition, but they have over 3,400 locations in the US, which allows them to dominate the market and operate on that cost-efficient basis, as I kind of mentioned, with economies of scale. The company's also been around for over 50 years and has that distinct brand image and that color orange that makes them distinct and recognizable. The Public Storage Advantage, or the PSA Advantage, it's a third-party management system that partners with other businesses and manages their storage facilities without directly owning them, allowing them to grow brand image without large purchasing costs, but still gaining revenue through those management fees. Next is their pricing power. So Kevin mentioned the strength of their balance sheet. So in addition to having the largest footprint, their leasing rates are cheaper than its competitors. So they're able to offer lower rates, but still maintain those great margins. And then lastly is the integrated growth model. After buying their properties, they continue to develop and expand them, again, maximizing revenue from each individual facility, spreading out those fixed costs, and again, tying into that economies of scale. And then this was a graph that was posted by the company in one of their investor relations presentations. It kind of highlights the growth and value creation the company aims to have through expanding their platform. It recognizes their location portfolio as being one of their biggest competitive advantages, specifically their scale. And then it just, again, once again, emphasizes their good margins and strong financials. Next is their tariff exposure. The company was a little hush-hush when it comes to talking about tariffs. They barely mention it at all in any of their investor relations things that they post, but really their risk comes from the materials they use when constructing these new facilities. Materials, specifically steel, have tariffs on them that result in increased costs and can even delay projects. And steel alone can make up a quarter of the cost when building a new facility. The company, in announcements and investor relations, again, spoke very little on the tariff impact that it has on the company, but still recognizes that as a risk. If costs increase for the company, they might have to increase rental prices as they switch over to maybe more domestic sourcing of those materials. But however, as we'll see for acquisitions, it's likely that PSA is focusing more on acquiring new facilities rather than developing new ones, as tariffs still remain high.
And their acquiring will be their bread and butter, especially with this tariff uncertainty. And as you can see, this company has been killing it with external growth. In September alone, They closed three sizable deals totaling to more than 1.4 billion, adding 130 facilities, nearly 10 million square feet. And one thing I thought was cool, their biggest milestone is the 2.2 billion acquisition from Blackstone, which added 127 facilities, expanding their Midwest and Sunbelt footprints. And they typically target these lease up properties that stabilize into the mid 6% yields.
And then a couple recent headlines. I couldn't really find much outside of their earnings calls for recent headlines, but one of the things I did see kind of talking about acquisitions was June this year, they announced it, and then August, they basically withdrew from this offer. But the company was in the works of acquiring a company called Abacus Storage King, which was a major self-storage player in the Australia region. Like I said, it fell through in August of this year, where the CEO of Public Storage reaffirmed that while expanding was a major goal for the company, especially in adding value, they were more focused on doing it so domestically rather than focusing on expanding internationally. And then in September of this year, their European subsidiary called Public Storage Operating Company, they announced senior notes worth 425 million euros, backed by major banks like Goldman Sachs and Morgan Stanley, with the goal of using those proceeds to pay upcoming notes, further expanding in existing facilities, and then repaying outstanding debt. And then in late October and early November, analysts at certain different financial services companies, RBC Capital and Barclays, they held their hold and buy recommendations for the company and then set optimistic stock price targets.
Insider trades, nothing concerning at all. I mean, it's a good thing to see insiders buying, but not much selling. The most recent purchase was in June by Ronald Harvner Jr., who is the longest director on board since 2002 as a trustee. And he's not selling, which tells us that he's not retiring soon. He just wants more of this company. So it's a pretty good signal. Now the competitors. So you'll see they're pretty similar. Not gonna lie, the public they compete closely with Extra Space and CubeSmart. They're very unique with their names, as you can see. They're the number 2 and number 3 players. Extra Space is the closest comparable. They are more aggressive on external growth and have a strong pricing technique. In their technology, they probably use the same, but similar. Especially after they just acquired Life Storage, so they've been seeing some growth there. They tend to grow faster, but run with a slightly more integration risk. CubeSmart, on the other hand, is a bit more conservative. With a more focus on dense metro markets, they lean on third-party management platform, which gives them a more balanced, lower risk model. Overall, PSA remains the scale leader, but both Extra Space and Cube are strong operators occupying different parts of the competitive landscape. And some statistics, market cap, kind of similar, not really. CubeSmart's mid cap, Extra Space and PSA are more of the large cap finds, and then pretty similar revenue. As you can see, Extra Space is going down in their revenue this year, while CubeSmart's going up. Net income, not the same story. Extra Space is improving their net income, and on the flip side, CubeSmart's is declining. And the price for funds from operation remains the same. As we can see, CubeSmart is the cheaper company in a way, but Extra Space kind of is where PSA is.
Yeah, so very, very similar companies. All three are very similar to each other. Each of them offer the same types of the storage solutions, as mentioned earlier, those climate controlled units, those transport units, and then gearing for the residential and business side. They have very similar storage solutions, and then packing service amenities, very similar. They also, each company has their own third-party management system, and then they all follow those similar demand drivers, focusing in the same high-density, high-income markets. The two competitors, CubeSmart and Extra Space, they're exclusively in the U.S., so they don't have the same international scale as Public Storage, but really they're all three focused in the U.S. And then the only other major similarity between Public Storage and CubeSmart is that their revenue is primarily generated through facility unit rentals. And then, even though all three companies do have similar offering strategies, there are a few differences. Extra Space has a bit more of an emphasis on their third-party management system. That's kind of where they lead the industry, and that's where they get most of their revenue. Both Extra Space and CubeSmart are focused on partnerships, collaborations, and acquisitions to grow rather than focusing on those new developments. And then both competitors are also newer, so their facilities also tend to be newer, and they have more amenities. Extra Space tends to lead the industry with newer tech integration, potentially resulting in better internal revenue management and digital marketing. And then CubeSmart is also more concentrated in certain regions rather than being a major player across the U.S. They really dominate the South and the East Coast.
All right. So the correlation matrix, as you can see here and from the chart you're about to see, they're very correlated in ways of 88%. So. All right. So volatility. April, Liberation Day, as we all know. And as you'll see, REITs are very rate sensitive. So when yields move up quickly, storage REITs typically sell off together. It all includes the Fed talking, which matches the dip you're seeing there. In August, these companies made their guidance more conservative. In November, there was another big sell-off tied to rate fears and REIT underperformance. But bond yields moved up again after some FOMC comments. So that's why we see a lot of volatility here. And in November, again, strong tailwind from the macro environment, which treasury yields dropping after cooler inflation readings really just caused that drop in all three companies and the market and the REIT. Oh yeah, sorry. BNQ is the real estate sector index. Nothing much to say here. Moving with the market, very similar, even with the VNQ. Yeah, closely correlated, but beating the REIT industry in the 6-year chart.
And then some financial metrics. So starting off with revenue, revenue for PSA and EXR, they've all been on the upswing since about 2021, slowing down a little bit more in recent years, but still growing. Cube's the only company that's been slowing down and remaining stable with revenues, only increasing about 50 million within the past 4 years. And then Public Storage's revenues have increased about 64% in that 2020 or since 2019 to 2025. Where EXR has increased about 150% since 2019, even though EXR has seen negative revenue growth for 2025. And then EBITDA, like revenue, all companies are still sharing that same pattern. Public Storage and Extra Space, they've had great EBITDA growth since 2019. And then once again, we see Cube kind of stagnating since about 2022. It shows that Public Storage and Extra Space have maintained profitability and constant and continuous growth year over year. So next up is NOI. So NOI is net operating income, shows up basically how much profit is generated from a property minus all the operating expenses like taxes, fees, and maintenance associated with it. Typically, that's how a property's value is determined, which again, all companies have shown good growth since 2019. Again, Extra Space has been growing the fastest, and then Cube showing 0 year-over-year growth for 2024. Since Public Storage has a lot more properties than Extra Space, its net operating income is much higher and shows that maximizing occupancy in each facility, thus increasing its revenue, also helps to boost their net operating income. And then EBITDA margin, very, very flat. All companies have shown a flat but higher EBITDA margin across all years. And again, EBITDA margin takes into account how much of the company's revenue comes from EBITDA, where higher margins indicate profitability and operational efficiency. Consistently, Public Storage has had the highest EBITDA margin year over year up until expected fiscal year 2025, where you see EXR kind of jumping there at the end, jumping over 20%. And this is likely due to their rising EBITDA and falling revenue for 2025. And then ROE. So 2021 and 2022 were all great years for companies, even better in 2023 for CubeSmart. These results are likely due to the highs that came from the pandemic in 2020, where mortgage rates were very low, again, resulting in increased demands for homes, which, like we said, is directly correlated with the demand for self-storage. We see Cube boost in 2023 compared to other companies, following an 88% increase in their net operating income that same year, where they saw the best same-store rental sales, increasing revenues for stores without their costs increasing. So that's why we kind of see a jump in 2023 for Cube. But in 2024, all companies have taken a dip. But EXR, you can see, has fallen 31% year over year. This is likely due to a fall in their net income for the year, and then a handful of one-off costs of about $110 million for the company. And then ROC, return on capital, it's a metric used to show how well the company generates profits based on the capital invested from both investors and debt, basically from financing. With revenues flattening out for all companies over the years and costs increasing, again, it shows how those costs eat into profits, which is why we kind of see a downward trend in ROC for each company. Some of these costs affect the entire sector, like increased interest rates, flattening occupancy, and then inflation costs. And then again, we kind of see Cube bump in 2023, again, likely due to their increased net operating income for the year, and then the same store rental increases for that year.
All right, here's where I get a little nerdy with some real estate metrics. So as we can see, occupancy rate peaked for COVID and steadily normalized around 92% for PSA. Nothing too big on this slide. Just wanted to point out their occupancy rates are relatively high, except for CubeSmart there. And this metric shows how many years of EBITDA it would take for a company to pay off all of its debt and preferred equity, assuming no growth at all. It's one of the most important leverage ratio for REITs because it reflects balance sheet strength and financial flexibility. Public Storage consistently operates at the lowest leverage in the group, giving them more room to acquire, develop, and withstand the rate volatility without stressing the balance sheet. The takeaway is that they are the most conservatively capitalized operator among major storage REITs like CubeSmart and Extra Space. And the fixed versus floating debt mix, this shows how much each company's debt is held at a fixed rate. So the higher the ratio, the more fixed debt they have. PSA is essentially all fixed rate, meaning interest rates have almost no impact on their interest expense. Extra Space, as you can see, carries more floating rate exposure, making them more sensitive. And then the implied cap rate. This tells us the yield the market is assigning them to, or assigning to each REIT portfolio based on the stock price. So it's net operating income divided by enterprise value, and it shows how expensive or cheap a company is relative to its underlying real estate. And across the board, the rates generally move together around 4.5% to 5.5%, reflecting high quality stabilized assets and kind of a normal for the industry. And price over funds for operation, I hashed on this earlier. It's equivalent to the PE ratio, which is why you'll see I do not have an intrinsic value calculation. Historically, PSA trades at a premium multiple because of the scale, but they have dropped over the years. And as of today, all three names have compressed to mid-high teens, reflecting softer demand and higher interest rates. But PSA still sits near the top. And same kind of valuation metric, but this is more conservative because it subtracts the recurring CapEx. This kind of shows investors what they're paying for each dollar of true cash flow or free cash flow. They expanded in all of 2021, 2022, and then they compressed as the rates rose and fundamentals normalized. And in these next valuation graphs, I kind of put it in place for not the trace valuation, but just to show how Public Storage is doing compared to their peers. So as you can see, Public Storage earns a premium valuation. On the left, PSA's net operating income growth has significantly developed and outperformed over other property types over the last decade. In the center, Public Storage operates with industry-leading net operating income, reflecting their scale, operating model, and they just have a lower labor intensity. On the right, PSA requires only 5% of net operating income in CapEx from the combination of high margins and low CapEx, and this creates one of the strongest free cash flows profiles in the entire REIT universe. I mean, 5 to 20%, it's pretty ridiculous. And this slide summarizes just Public Storage's valuation drivers. On the right or on the left, you can see all the drivers. I'm not going to read them all out, but on the right, you'll see PSA trades around 16 to 17 funds from operations, which is a modest premium to peers today, especially considering their scale. Historically, this premium is down, meaning the stock trades below its long-term relative valuation, despite maintaining its leadership advantages. And this is my favorite slide out of the entire deck because it visually captures why Public Storage consistently outperforms. Across every major operating metric, Public Storage leads the sector. They generate the highest revenue per square foot, spends the least on payroll and utilities, operates with the strongest net operating income margins at 79%, and converts more of their earnings into free cash flow. So that brings us on to the thesis. So as you can see here, a little bit going defensive, recession resistant, demand, valuation of financial strength, external growth through acquisitions. They are a stable, like I just said, recession resistant REIT that stands out as the most attractively valued name in the self-storage space, in our opinion. The company has minimum tariff exposure, solid demand through economic cycles, and that fortress balance sheet supported by their A credit rating. And as interest rates move lower, as we'll see the Fed keep cutting, are they going to keep cutting? But they're getting lower. PSA benefits from the cheaper financing and improved free funds from operation yields. And combine this with their strong acquisition pipeline and proven ability to integrate new facilities, PSA offers a compelling mix of downside protections and steady growth. And we saw a lot of acquisitions with their properties, but as these rates move lower and tariffs ease, if they ever do, with this administration, hopefully they'll start building more, but right now they're just focused on acquiring that external growth. So,
and again, if it wasn't obvious, we are proposing a buy for this company. We believe that the growth is there, the demand is there. We believe in their financial valuations. We believe that this company is a good defensive stock in the case that the economy kind of takes a downward turn. We're still going to see the demand for public storage and self-storage solutions, and we think that this is a good defensive stock to add to our portfolio.
Yeah, and if you just look and see the sector that we can weight, I know we're not talking about weighting, but the S&P, they have a 1.8% weighted towards real estate. This isn't going to be that growth stock that shoots up 20% in a year. This is going to be more of we expect a bearish market sometime in the future. This will help our downside risk at 2%. I mean, you can't really beat it. So yeah, I guess we'll see what the decision is from you all. Would love to hear it. And now we're going to stop sharing.
Yes.
Have a good time off.